Hey, y'all, welcome to the Winning at Life podcast. You ready for another podcast? A really great topic today. I was tossed this idea, and I've been talking about this a great deal lately, just not here on the podcast, and we may cover other versions of this, but, loosely put it, I'll put this topic here is why asset allocation might matter more than you timing the market. Timing the market, I think, is kind of hazardous. So I want to talk to you a little bit about that today. We bring this podcast to you every Wednesday at 3 o'clock. So if you're listening to a replay or streaming the podcast, know the fresh ones come out every Wednesday at 3 o'clock. Yeah, my team just said, yeah, you got the time right. Good. Okay. And I appreciate you listening. And this is kind of a fun format. It's a bit more casual and relaxed. Not that I wasn't casual on the radio show that is still airing for more than 16 years now on iHeartRadio. And you can catch episodes of that on Saturday mornings as well. But we've got a lot of people that have supported this over the years. A shout out to our sponsors, J. Heath and Company CPAs, Mortgage Gumbo with Dwayne Stein. That'd be over there at mortgagegumbo.com. W.J. Blanchard Law. He handles estate planning. Mosquito Joe, he don't like mosquitoes. I don't either. So neworleans.mosquitojoe.com, Spitali's Deli and Catering, JJS Audio and Video. That dude is always doing work for me, and he's awesome. So check him out as well. And none of this be possible without iHeartMedia as well. And then we also have to thank this firm here, Gregory Ricks, Total Wealth, makes this all possible. Couple of call to actions here. Be sure to subscribe to the Gregory Ricks Total Wealth YouTube channel for on-demand financial content. My team is putting together a lot of great ideas. There's going to be more information coming. There's going to be more ways to learn and gain knowledge so you can get more money, grow money, and especially keep it, but more important, to compound that money. That's the magic. And you look, if you hadn't started saving, start tomorrow. Assuming it's too late in the day today to start when you're watching this. But you need to start immediately so you can get compounding going. I was having this discussion about that. If you don't have emergency savings, or what if you've got debt? I used to kind of say, well, you need an emergency fund before you invest, and you need to get debt free, from revolving credit. And then I changed my mind after a while. I said, Gregory, you've been telling them wrong. They have to do all three at once. But if you don't start investing right now, you're missing compounding, and you can't get that back. Compounding that would have started yesterday to today, or last year to this year, it's gone if you haven't invested. So you got to start saving, start investing to create the compounding. And you can solve the debt, and you can solve the emergency savings, but you can't make up for lost time on compounding. So it's just a pet peeve of mine is to get you to do that. And once again, new podcasts every Wednesday at 3. Like, comment, subscribe, hit the bell notification to be alerted when we release new content. And I was going to say tell your friends, but go to the highest mountaintop and tell everybody about this show. How about that? Here's something, and I had a friend just talking about some of his friends regarding their investing. And I said, are they money managers? Oh, no, they're just doing it for themselves. And what he described, it sounded like day traders. I told them, I said, here's my prediction. They won't be doing it for long. Just trying to time the market is kind of a fool's game. I'll define it as here. But a couple of takeaways. Trying to time the market consistently is impossible, even for professional money managers with sophisticated tools and real-time data. Missing just a handful of the market's best trading days can significantly reduce long-term returns, and those days are nearly impossible to predict in advance. They're usually following some scary days where you're like, oh my gosh, there's no way I'm getting back in. It's going to keep falling. And next thing you know, it has some ridiculous up days or a ridiculous up day. When you miss those days, it kills your long-term return. A well-structured asset allocation built around your goals, risk tolerance, and time horizon is more reliable path to help pursue long-term success than reacting to short-term market swings. You should not be investing money that you're going to need next year. You should not be investing money that you need next month. That's short-term money if you're needing it. That is not a long-term investment. Long-term investment needs to be for a great while. And I'll give you another number here as well. I think this is significant, and I've talked about this over the years. Let's look a little bit here at historical data. And look, you can go pull this up on your computer. You can get AI to pull it up, and in any number of sources to pull this up. But what I've got this from Transamerica Retirement Solutions, also AMG Wealth. I can, give you more resource. But here's something, and I've talked about this over the years. I'm just looking at a chart of this that's right in front of me. But over the years, I've given this number at least some time each year or periodically each year to remind people the importance of long term. So if we're looking back at historical data, say the last 98 years, including the past 86 years, there has never been this is so important. You might want to write it down. There's never been a negative rolling 20-year period for the U.S. stock market based on nominal returns. Even after accounting for inflation, the market has reliably produced a positive return across every 20-year period. So how long are you investing for? If you're in your 20s, you should put it to work and just keep adding to it. S&P 500 is a great place. You don't need a manager. You need to just hold tight and just keep putting money in. One-year holding periods, the market ends the year with a negative returns roughly 26% to 31% of the time. 10-year holding periods, negative returns are rare, but happening less than 10% of historical periods. And once again, 20-year holding periods, zero losing periods. Even if an investor bought at the absolute peak in 1929, just before the Great Depression, and holding for 20 years, still yielded a positive return. Think about that. Now, where you are in life, if all of a sudden you've reached a point where you don't have 20 years, then you need to start diversifying. And I think it's okay to diversify, because one of the ways I look at this, because I know how it's going to go, and we test clients for risk numbers, and that's to see how they feel about risk. And basically, it's a score from 0 to 100, but nobody scores. And I've rarely seen high 80s, low 90s. And then, kind of if you score 10 or less, you have no risk tolerance. And I was discussing this earlier today, and I said, look, somebody scores in the 70s. I'm going to use my wording a little bit different here. They're not being truthful to their risk. And why do I know this? Because I've done this for a long time. And typically what we do is we allocate people more conservative than what they test for. They're like, oh yeah, I've got the tolerance. It's going to be fine. And all of a sudden the market's off 15, 20%. You know who I'm getting a call from? Them. And based on what they were saying and their test scoring, they shouldn't be calling me. And there's sometimes where, and we allocate them more conservative than they score, but I just remember one after COVID, and you know, the markets had went down a great deal, and a client, she called me, and I spoke with her about it. She's like, I'm worried about my retirement. You know, I was planning to retire in a few years. I'm kind of really worried about it. I said, have you taken a look at it? She said, no, I just saw the news and I thought I'd reach out. I said, well, here, let me go over it with you. Her account wasn't down that much considering what was going on. And I said, you're going to be fine and you're retiring in a few years. This is going to get better. She was just worried. So that's why that test matters, because I want to see how they're going to respond. So from being a financial advisor, we help with allocation. We help people with planning. We help them with long-term investing. I kind of relate it to a boat ride in the ocean. If the ocean's pretty calm, it's okay, but once in a while it's going to get kind of rough, and people like, this boat is never going to sink. It's going to be fine. We've got it smoothed out, but all of a sudden it gets choppy for a short period of time. They're like, what do we do? It's going to sink. We're going to drown. It's like, no, just stay calm. Just give it a little bit of time. It's going to smooth out. We're there to make sure investors, clients, do not make bad decisions, because somebody panicking and selling early because it's down, like, oh my God, I got to get out. Well, then you shouldn't have had all your money in. And that's why I think diversification is really important. And that's where in my book, see it right there, Retirement Deserves a Helpful Hand. One of the sections in the book kind of talks about that. Market volatility in chapter 3. And I highlighted a few excerpts here for you today, and I'll read it to you. There's only, let me go back. Should have started over here. For one thing, it's important to recognize the value of diversity. Now that I'm not talking about diversity of assets among different kinds of stocks, or even different kinds of stocks and bonds. And that's where people think, oh, I got to hold a lot of stocks. I got to, the S&P 500, I got to buy 500 different stocks. Buffett and Munger kind of said, you just need really 5 good companies with 5 great managers. Okay, that's a couple billionaires speaking from their perspective. They weren't like, how many companies can we own? So I was speaking of diversity of assets among different stocks, or even different kinds of stocks and bonds. That's only one kind of diversity. Stocks and bonds, though different, are both still important market-based products. Even within a diverse portfolio, most market-based products tend to rise or fall as a whole. I was having a discussion with someone recently about that. Say, well, you know, bonds can be a great hedge against stocks. I said, well, have you kind of looked at historicals? They tend to fall too. And everybody for a long time talked about modern portfolio theory. to kind of be that magic theory of market risk. And you know what? That was blown up when we had a market situation where stocks went down and the bonds were bad as well. So stocks and bonds, though different, are both still important market-based products. So once again, they tend to rise and fall as a whole, just like an incoming tide. I like how I wrote that in the book. Therefore, a portfolio diverse in only market source products won't automatically preserve your assets during times when the market declines. In addition to the sort of horizontal diversity you have by purchasing a variety of stocks and bonds from different companies, I also suggest you think about vertical diversity or diversity among asset classes. This means having different types of, including security products, bank products, insurance products with varying level of growth potential, liquidity, and protection, all in accordance with your unique situation, goals, and needs. I've been doing this for a long time, and I was coaching up an individual recently about that, and they were kind of, they're big fans of the stock and bond portfolios. And we used to really listen to clients and take their suggestions. And if they kind of wanted to go that way, we would allow them to go to. And, when the seas got rough, those waves started crashing, they'd get scared and run, or kind of like, get me out and so forth. When we basically put the invest 50-50 philosophy, and why do I call it that? Because it's creating balance. It's creating diversity in asset classes, and it's built with expecting rough seas, the waves to get really violent. We do it that way to minimize that. So yeah, I like me some stocks and bonds, but you know what I like even better in that mix? I like buffers that limit downside exposure. And then we also like money to be insured as well. So on the safe side of 50-50, we want some safe money. We want some absolute no down exposure to money. And then another topic I've talked about in the past, we'll cover again, not today, but it's sequence of return risk. And I even made a note here earlier when I was covering my notes. I wrote here, is a risk account liquid when it's down? You can kind of say, well, some insurance tools like annuities might have surrender periods or fee to get out early than the surrender period. So, which would be a cost off of the value of the account. Well, if you're in a risk account and it's gone down and you're panicking, the question to you, once again, is a risk account liquid when it is down? Oh yeah, you can sell it, but what did you give up? You gave up some of your principal. So really, is it liquid? I don't think it's liquid. There's a cost to exiting. So it's also using risk money or a risk account to be taking your income from. You're impacted by negative sequence of returns, sequence of return risk. So you're selling off shares or part of that account to feed your income. In a down market situation, you're selling when they're down, and those gains are locked in. This fares better when you are taking income from assets that are outside of risk. So, with the stock market history and knowing the longer term it goes, if you let it have time, it's going to come back. But if you're taking income from it, it's not going to come back. That's the sequence of return risk. So that also goes back to why the longer you can hold that account, the better. 10 years and more, it just gets better. 10 years and more for that money. 20-year holding periods, what did we find out today? It's always up based on historicals. So we want to think about, When another thing in the book, you need to get a copy of the book. Some good stuff right here. This might be the best whole chapter in the book. I might be biased to that chapter. But when you're looking at overall diversity of your portfolio, part of the equation is knowing which products fit in what category, what has liquidity, what has protection, and what has growth potential. You might think of liquidity, growth, and protection as primary colors, while some products will look pretty in yellow, red, or blue. Others will have a mix of characteristics, making them more green, orange, or purple. Hey, I like me some purple, too. I'm kind of colorblind. You might not see me, if you probably see me. Well, Gregory's been reading too much of his book in colors. He's all confused with how to dress. Had Stacy change my coat today because she said, well, that doesn't go with that shirt. So, yeah, I'm colorblind, but not when it comes to money. I like to think of the growth category as red. It's powerful, somewhat volatile, but it also is a category where we have the greatest opportunities for growth as well as chance of loss. Often products in the growth category will have a good deal of liquidity, but very little protection. Liquidity, think of it as yellow. It's my liquid category color. I typically recommend having at least enough money to cover 6 months to a year's worth of expenses in emergency. It's like your cash account, money market, so forth. Protection, the color of that protection to me is blue, which can incorporate products such as annuities, tranquil, peaceful, sure, even if it lacks certain amount of flash. Yeah, it might not be something you brag about on the golf course, but think about that from that standpoint. We're out of time. We're just going to have to cover some more of this. I just think this is a great topic of you got to invest in a way that you stay invested, that you allow time to work for you, not against you. And when you see all that noise and see it's down, instead of getting worried, kind of like, let me see, do I have a little bit extra I can put in right now? Because the volatility shouldn't scare you. Why? Because when you're taking income or distributions out, it's from a stable place, and you can let those horses run, so to speak. And that's why you should work with an advisor. Why? Because we can help stop you from jumping overboard. It's going to calm down. The winds are going to relax. It's going to be okay, especially in the long term. Saving through life is decades. Retirement is decades. So just think about it that way. Look, if we can be of help with you on this, helping you with diversification, helping you along this journey, and that's what it is, call the office, 504-832-9200. The website is GregoryRicks.com, so visit our website to see our upcoming events. Email info@GregoryRicks.com. We offer in-person and virtual visits. Be sure and subscribe to our YouTube channel as well as for more financial content. Thanks for watching, and tune in to our podcast next week and check out more of our content on our YouTube channel. Remember, subscribe, follow, share, all of that. Y'all have a great week. See you next week.